The information contained within this video is for entertainment and informational purposes only. Any financial decisions made by the material within this video should only be used in consultation with a financial professional. JohnGaltFLA.com and the host, John Galt, cannot be held liable for decisions made using the information provided. Welcome one, welcome all. Today we're going to talk about the stock market crash of June 2011. I think we're in line for one. First, we're going to look at a chart of the year to date ending on June 3rd of the stock market. This is a weekly chart, and if you'll notice, we've had 5 straight weekly declines, a pattern we have not seen in about 3 years. It's my theory, and this is only a theory at this point in time, but I'm going to go with it, that we're about to see a nice 15 to 20%, possibly a little bit greater correction in the weeks ahead, a recovery over the summer, and then a rebound into the fall, which will then capitulate and cause mass hysteria once again in financial systems worldwide. To get some idea of this from the current Dow, let's look at the Dow in 2008. While we didn't have 5 straight weekly declines, we did have a similar pattern in May of 2008 as it became apparent institutions like Bear Stearns, Citigroup, Morgan Stanley, etc. were all in grave financial difficulty, especially due to the difficulties with Fannie and Freddie and the mortgage-backed security market. Numerous programs were underway from the Fed, and it didn't do anything to save it. If you'll notice, after we bottomed at the end of June, we had a little bit of a rebound in July and sort of floundered through August, even after Fannie and Freddie were nationalized. You see a similar pattern on the S&P 500. Let's look at the S&P from 2008. We had a total breakdown in June, a little bit of a rally in July and August, and it sort of just floundered but never recovered back to its all-time highs. And this is the pattern I think you're going to notice when we look at this year's chart. Reflecting back on the 2008 chart, if you see the massive shifts, how at the 1st of May we had almost a perfect double top there, where you had 2 weeks in a row where we didn't move that much. It sort of flattened lined and then boom, started to capitulate. Down, up a week, down, 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 down. There's your 5 weeks decline in a row, with 1 week there in the 3rd week of May where it just sort of rallied, counter-trend rally, but then failed the following week. We've seen no counter-trend rally, but we've seen some very weak attempts at it within the current year's rally and moves in the month of May going into June. I think what you're going to notice from this chart is there's a potential for the same pattern to retrace itself. Here's the current chart. If you look at the part, we had the 2-week period there right before the start of May, then a total capitulation and rollover. We should continue to stair-step down if this pattern holds. If we break 1020 on the S&P 500, all hell's going to break loose. I think right now 1200 is the first line that's in doubt of support. After that, 1175 to 1180. Then we're going to go right back down to 1000 on the S&P 500, and I think that's a reasonable point to say the correction is over for the summer. NASDAQ in 2008 had a very unique pattern. It didn't sit there and follow the same exact pattern as the S&P and Dow, but did have that 5-week capitulation period where it just basically rolled over and tanked going in through June. Then we had the counter trend bounce in July through August. Got a little bit of stronger bounce. The small caps generally do get a little bit more bounce and at risk, because there's a risk-on trade, as they like to call it. But in the end, it capitulated severely when we got to the autumn of 2008. Thus, the patterns are beginning to get a little bit more apparent. We're going to look at the NASDAQ for this year, year-to-date, weekly chart. You don't see the 5-week breakdown, but you do see a massive shift last week where we shattered a lot of technical support, and we should come back down and retest the levels, I would say close to 25 before it's all said and done. It's a long way from being over. The markets are going to play games with us here. The Fed is going to sit there and intervene wherever possible to try and save this thing, and I don't think they're going to be as successful as they like. If you look at the NASDAQ today, it's trading at 2731. 2500 is your key support level. I don't think it's going to hold. Going back to the 2008 chart, you see the same thing that we saw in this year's chart, except there's that consolidation period. I circled it for you to give you some idea of what I saw that said, okay, this sucker is ready to break. It's broken, and I think we're now at the point of maybe the first large candle there on the chart where you see the 2 in the middle. We might get a bounce this week. I seriously doubt it'll be as substantial as it was back in 2008, and then it's going to roll over. If you look at our chart for this year, you see that I've circled it on this one. We've already had that little bounce up last week, which I think was the extent of what we will see as far as a counter-trend rally. And now I think we're going to see 4 more weeks of decline right up until the July 4th holiday, maybe a couple of weeks afterward. I think the Federal Reserve action on June 22nd plays a large portion on this. So I think we're going to see a quote-unquote crash or correction in June of this month. And it's going to be shocking to those who are holding stocks thinking that, okay, the economy's bad, but it's not that bad. The Russell 2000 in 2008 had a similar pattern also. However, it was the strongest of the group and was able to have a counter-trend bounce back up to new highs and to pass the low points in August as people began to believe that it was the safest play. If you think about it, though, it's a very dangerous play because it's a risk-reward gambit. You can make a lot of money in a short period of time if you know what you're doing. This is not for amateurs. This is a trader's market for the rest of this year. The current chart is in a very similar precarious position. You see the 2 big candles going into the last week of April, first week of May. Breakdown, counter-trend bounce last week. The week before last. Total capitulation last week, it looks like. It's a nasty red candle. I think we're going to come down the next 3 weeks, maybe 4, in the Russell 2000 as the small caps are liquidated. And we have a breakdown in the markets, especially for the risk-on trade. We go back to what happened in precious metals, though. We see gold in 2008 followed the stock markets. We haven't done that yet. Gold held out a little bit better, rallied through June, and then capitulated in July. I think that's the move we're going to see this year, except I think we're going to start capitulating this month. I think that by the June 22nd Fed decision, we will see a breakdown in the gold markets, and I think it'll be a rather substantial one. We might even come back down and retest the 1260 to 1290 level, barring something happening in Europe. This is the current year-to-date chart, cash gold, by the way, continuous contract. If you notice, we've rallied nicely, very little in the area of declines. We've built a very firm long-term consolidation. I think a short-term break, while drastic, would be a disaster to some. It would be healthy for the longer term of the market to go back and retest the lows set late last year. If we can get into that 1280-ish range, we're going to be fine. It will come back as the dollar has to be weakened. Silver in 2008 took the beating right on the chin, paralleled gold to some degree, rallied through June and then cratered in July. I think silver will follow a similar pattern, except this June will make an all-time high, a new nominal all-time high, above $52.50 an ounce. After that, when the Fed makes their decision made public, and you'll know it by the action of Goldman Sachs and J.P. Morgan Chase and the trades that they execute, you'll get some picture of what the future is going to look like. The dollar is destined to rally, and I think we're going to see this same kind of drastic price action in silver that we saw in 2008. Here's the chart for this year, and if you look at the silver chart, we've had a correction, a brief correction from the attempt run up at the high. We've consolidated the last 4 weeks basically. I think we're going to rally back up one more time, surpass that previous high, and then we're going to sit there and see a total washout in the precious metals markets, primarily the paper traders. There's not that much physical left, so just watch what happens. It could give you one last buying opportunity. My floor is 32 to 32.50. We could crack to 28. The U.S. dollar is your key. Here's the U.S. dollar index from 2008, and if you notice, we had a nice play lower in April, then we rallied briefly early June, then we fell again in July, and then we rallied strong going in through the month of August. This is the pattern I expect to see, although I expect it to start executing a little bit earlier this time. I think we've already seen that one low set like we did back in 2008, and I don't think we're going to see a repeat of that this year. I think we've seen our low right now in the U.S. dollar. If you look at this chart of 2008 where I've circled it, this is the area where I think you watch for another rally up, correction, and then a strong rally to get out of this bottom that we were in. I think that's the exact same pattern we're going to witness in our stock, in our dollar, in our current era, the 2011 trading time, except it's going to probably begin in mid-June. We'll bottom out, and then after the Fed announcement, start this strong rally last week of June, right up and through the summer, all the way up into September. and then boom. As you see, we've made our first low, and it's basically almost the inverse of the stock market. You see the two red candles there at the bottom that get the two red candles declining, then a white candle rally. Then we've had another decline this week. I expect a counter trend rally this week because I think the Greek debt crisis is going to explode in their face. I don't think they're going to resolve that. People are going to start selling the euro. It's way overpriced relative to what it should be. There's no support fundamentally for it, and technically that chart's ready to break down. Here's where I've circled what I think will be our bottom for the year in the United States dollar. I don't think we're going to break 72. If we do, we're looking at the potential for a currency collapse. But on a technical basis and on a fundamental basis, we'll flounder between 72.70 and 74 at most in the next 3 weeks. And then boom, a strong rally leading into August. Please stay tuned to the videos. I'll be doing more of them now. We had to set up a new radio station. JMR, Just Measures Radio, goes on the air live tonight, June 6, 2011. Yours truly will be hosting from 7 p.m. to 9 p.m. Eastern Time. Cope Reynolds with the Shooting Bench will be on from 5 to 7 p.m. Eastern Time. I'm 7 to 9, and Bobby with Just Measures hosts the Pathfinder program from 9 to 11 p.m. More hosts will be added in the weeks to come. Archives will be available. You can click on the page link at the top of johngaltfla.com. Right underneath the word Shenandoah. You can access everything there, and JustMeasuresRadio.com should be active this afternoon, where you will have the ability to chat, interact with your friends, watch the precious metals markets, and hear the news from a patriot's and constitutional perspective, something this world sorely needs. Until later, good night now, or have a good day trading.